Hello, everybody. My name is Diaman, and I provide daily updates on Tesla, markets, and technology. Let's get started right away. Markets are generally down today. Nasdaq is down 1%. S&P 500 is down 0.7%. Oil is down percent to $64 per barrel. The long end of the curve continues to go up by 4 basis points for a third Treasury yield to 4.91. 10-year Treasury yield is at 4.22. We have a lot of economic data that came out today. We're going to talk about a bunch of those. Let's look at the heat map first. NVIDIA is down 3%. Broadcom is down 4%. AMD is down 3%. Oracle is down 6%. So technology stocks are generally down. Tesla is down 3%, still overvalued by 10x, I think. Farm and heavy construction machinery is down quite a bit as well. So all the cyclicals. And financials are up today, though. Financials are up. Maybe we can get a glean of what's going on there. Google is flat. Meta is down 1%. Amazon is down 1%. Apple is flat. Uber is down 4%. Semiconductors are generally down. Let's read the article of the day. Wall Street falls as Dell, NVIDIA drive tech losses. Wall Street's main indices fell on Friday, pressured by technology stocks such as Dell and NVIDIA, while investors parsed inflation data showing tariffs have started feeding into prices. Dell fell 8.4% and led declines on the S&P 500 after the personal computer maker forecast quarterly profit below estimates. The broader technology sector shed 1.7%, cooling down after rallying through the year. NVIDIA lost 3.5%, and an index tracking chip makers slid 3% a day after the AI chip leaders' dour China market expectations disappointed investors accustomed to blockbuster forecasts from the company. The spotlight was on a Commerce Department report that showed the Federal Reserve's preferred inflation gauge, the PCE price index, rose 2.6% in July, as expected on an annual basis, above the central bank's 2% target. That's not the story. We're going to dig into that a little bit more. Let's see. Reuters does a bad job of summarizing, the good stuff. So let's switch to Yahoo Finance. Stock market today. Dow, S&P 500, Nasdaq slide as NVIDIA leads tech losses after PC inflation consumer data. Let's see if they give a better summary. U.S. stocks fell from record highs on Friday as Wall Street digested an update on consumer inflation that showed prices firming higher above the Fed's target in July. We talked about NVIDIA is down over more than 3%. A key Fed watch measure inflation rose as expected in July, new government data showed Friday. The core PCE index, it should be price index, closely studied by the central bank, rose 0.3% on a monthly basis and 2.9% on an annual basis, above the Fed's 2% inflation target. Both numbers matched economists' expectations, though the annual pace marked the biggest rise since February. That's the real story. The writing needs a lot of work, but that's the real story. Meanwhile, the U.S. consumer sentiment declined to a 3-month low as consumers in a University of Michigan survey suggested they expect inflation to surge over the next year, but lower than the previous reading, and they didn't say that. Friday's data comes after signs of a resilient economy helped lift S&P 500 and Dow Jones to a new all-time highs on Thursday. Bets that the Fed will ease rates at the September meeting were still riding high Friday, and traders were pricing in an 87% chance of a quarter-point cut following the PCE reading. The inflation data caps a whirlwind week for markets gripped by NVIDIA earnings and President Trump's efforts to oust its governor Lisa Cook, which took a new turn. On Friday, a judge is expected to rule on a bid from Cook for a temporary restraining order. Interesting. Despite the pullback in stocks on Friday, the major indices were all set for the longest streak of consecutive monthly gains in more than a year. The tech-heavy Nasdaq was set to see a 2% bump in August, marking its 5th straight monthly rise, the longest winning streak in nearly a year and a half. For their part, S&P 500 and Dow were set for their 4th consecutive monthly gains, on track to add 1.6% and 2% respectively, the longest since September 2024. And Russell 2000, which includes small market capitalization companies, eyed a 6% jump in August, set for its 4th monthly uptick, the longest streak in over 4 years. All right, we're going to talk about that later. Let's switch to Tesla and some automotive news, and now we're going to talk about macroeconomics and some Fed news. And now we're going to dig into one report. Tesla reveals Model Y performance trim for Europe, where sales are tanking. Tesla unveiled the new Model Y Performance, a high-end variant of the EV maker's volume crossover SUV. Though it's only available in Europe, where Tesla sales have created recently, it will be coming elsewhere soon. The Model Y was updated just a year ago with a slew of updates, but the performance trim adds a bunch more. In addition to exterior updates like a new front and rear end, new wheels and tires, and carbon fiber air bits, the biggest updates come under the skin. New motors and higher density batteries give the Model Y extra grunt, allowing the car to go from 0 to 60 in less than 3.5 seconds. That hasn't really, like, this acceleration piece hasn't really spurred sales, because really every other EV does the same high acceleration. And people can't really tell the difference between 3.5 to 3.9. They don't really base purchase decisions on that. Adaptive suspension gives the car better handling and a firmer ride, with new drive modes tied to those settings meant for aggressive riding. Inside the cabin are new sports seats, improved sound damping, and a new 16-inch touchscreen. The updates and performance enhancements don't come cheap, however. In Europe, Model Y Performance will cost around $74,000. I mean, that's like, whereas the cheapest Model Y base rear-wheel drive comes in at $54,000. Tesla reports the Model Y Performance ranges around 360 miles, but this is using Europe's generous WLTP cycle of measurement. The performance variant of the Model Y will most likely be coming to the US, and prices will likely be lower. The previous generation Model Y Performance started around $52,000, so figure a starting price a little higher than that. Tesla's performance variants are typically lower volume vehicles that in case compete with EVs like BMW iX, Audi Q4 e-tron, Cadillac Lyriq, to name a few. Even Ford's sporty Mustang Mach-E GT, Hyundai's Ioniq 5 are targets of the Model Y Performance. A better and sportier Model Y may be what's needed to push Tesla sales in both Europe and the US. That's not going to make a difference. In China, for example, the company just released the Model Y L, a larger version of seating for 6. In the US, Musk has said a cheaper version of Model Y is coming, likely with a similar form factor but reduced features, soon after expiration of the $7,500 federal tax credit. Yeah, I don't think any of these tweaks are going to make the difference for Tesla. Henrik Fisker quietly wound down his nonprofit after his EV startup bankrupt. Fisker, the founder of failed EV startup Fisker Inc., and his wife Geeta quietly wound down a private charitable foundation established in late 2021 that was supposed to incubate innovation in healthcare, education, sustainable mobility, and all causes that help support the planet and improve and further the lives of people and animals. A tax filing submitted to IRS in December 2024, 6 months after Fisker went bankrupt, was marked as the foundation's final return. The filing was made public earlier this year. The Geeta and Henrik Fisker Foundation, as it was known, ultimately only made around $100,000 in grants across its 3-year existence. Henrik Fisker did not respond to messages seeking comment. The brief existence of Fisker's foundation is another example of how the boom of EV startups in the 2020s, many of which went public via special purpose acquisition companies, SPAC mergers, helped fuel a rush of wide-eyed optimism. When Rivian went public via traditional IPO in 2021, it announced its own foundation, flush with 1% of EV's company's equity. While that stake was worth around $643 million at one point, it eventually shrank to under $100 million. But the Rivian Foundation is still kicking. The nonprofit gave out its first $10 million in grants last year, and its website shows that the foundation has made another $2.2 million in donations to date across 2025. Okay. I don't know why that guy gets so much attention, but GM plans shift shutdowns at its Factory Zero EV plant in Detroit, Hamtramck. Okay. GM's EV manufacturing plant in Factory Zero in Detroit will partially shut down first and second shift production temporarily beginning September 2, the company told employees August 27 in a memo obtained by the Detroit Free Press. Production of the GMC Hummer EV and Cadillac Escalade IQ will be impacted, the company confirmed. Production is slated to stop the day after Labor Day and resume October 6. Meanwhile, the temporary layoff in place for second shift production also is going to be extended until October 6. The move impacts approximately 360 employees. BYD posts shock profit drop as price war hits Chinese EV maker. BYD reported a surprise drop in quarterly profit due to fierce price competition in its home market, piling more pressure on the Chinese carmaker already poised to miss its annual sales targets. The net income slumped 30% to $892 million in the second quarter, missing analyst estimates of a modest increase. Revenue of 200 billion yuan also fell short of expectations. Heavy discounting in China contributed to gross margin shrinking to 16.3%, the lowest quarterly result since 2023. From a profitable perspective, I think BYD and Tesla are very comfortable, except that BYD does it with cars priced about half of Tesla's average selling price. So that's the key difference. All right, switching to Fed news. Cook lawyer says fraud claims are Trump's weapon of choice. President Trump's fraud allegations against Federal Reserve Governor Lisa Cook have become a weapon of choice to seek to remove officials who are obstacles to his agenda, her lawyer argued at the first hearing in her lawsuit challenging her firing. Abby Lowell told a judge Friday in Washington that Trump's repeated public statements criticizing the Fed's work signaled a willingness to remove governors who refused to vote to lower interest rates. Trump's motive, she argued, signaled he didn't have the necessary cause to fire Cook. The hearing, which lasted more than 90 minutes, caps weeks of sparring between Cook and the administration and signaled the beginning of a pitched legal fight over president's influence over the Fed. Cook asked for the emergency hearing after requesting an order that would allow her to keep her job while she presses a lawsuit to block Trump from permanently ousting her. U.S. District Judge Gia Cobb, who heard arguments from both sides, suggested she may not rule right away. Justice Department Attorney Yakov Roth argued that Cook's failure so far to explain the alleged mortgage discrepancies suggests she did something wrong and supports Trump's right to remove her for cause. If there was an explanation, he said, we would have heard it by now. Cook sued Trump on Thursday, arguing that his attempt to fire her was a power grab that could cause irreparable harm to the U.S. economy. The president is seeking to remove her over claims by FHFA Director Bill Pulte that she lied on mortgage documents. In the lawsuit, Cook suggested that an unintentional clerical error may have been behind the mortgage dispute. Interesting. Just before the hearing, the Justice Department said in a filing that courts should defer to Trump on whether he has sufficient cause to fire Cook. Her request for an order temporarily allowing her to remain employed should be denied, the government said. Cook is highly likely to prevail on the merits of her claim that Trump illegally fired her without cause, they argued. Highly unlikely to prevail on the merits of her claim that Trump illegally fired her without cause, they argued. Yakov Roth, Principal Deputy Assistant Attorney General at the U.S. Department of Justice, on the right, arrives at the federal court in Washington. Okay. Removal for cause is a capacious standard, and one Congress has vested in the discretion of the president, the government said. Even if it were subject to any judicial review, and over a century of case law suggests it is not, that review will have to be highly deferential lest it intrude into the president's constitutional authority over principal officers. Now, it's going to be interesting to see how this one pans out, but unprecedented pressure on the Fed by the administration. Fed's balance sheet drawdown enters new stage as reverse repos largely drained. The Fed Reserve's efforts to shrink the size of its balance sheet is moving into a more uncertain phase as a key proxy of excess liquidity has been very nearly extinguished. Over recent days, cash flowing into the central bank's overnight reverse repo facility has fallen very close to zero, capping what has been long and slow grind from a peak of $2.6 trillion on the final trading day of 2022. The facility takes in cash primarily from money market funds, which use it to park liquidity assets beyond what they need. Reverse repos have been falling since the Fed in 2022 began the process of shrinking its balance sheet by allowing a set amount of Treasury and mortgage bonds to expire each month and not be replaced, a process called quantitative tightening or QT. That's taken Fed holdings from a peak of $9 trillion in the summer of 2022 to the current level of $6.7 trillion. The rate the Fed pays for these de facto loans is a key part of the central bank's monetary policy toolkit and helps set a floor for the central bank's interest rate target, currently in the range between 4.25% and 4.5%. On Thursday, reverse repo stood at $32 billion, a level last seen in the spring of 2021. Modest sum was always expected to remain in the facility, even as use shriveled as the Q2 process reduced liquidity in the financial system. That said, analysts do expect to see periodic usage surges, particularly around month and quarter ends when there are swings in the market liquidity that can cause funding pressures. QT is expected to go on for a while, with market participants projecting it can run until the start of next year. While reverse repos, which soaked up much of the aggressive stimulus provided by the Fed during the COVID-19 pandemic, are effectively drained out, Fed officials believe there remain large levels of liquidity left in the banking system that QT can bring down. The effective end of reverse repo usage will test that notion, however. With Treasury borrowing issues settled after the passage of the Republican spending bill, Q2 will now begin to remove reserves from the banking system, which means liquidity will drain more quickly at this point. Let's read that part again. The effective end of reverse repo usage will test that notion, however. With Treasury borrowing issues settled after the passage of the Republican spending bill, QT will now begin to remove reserves from the banking system, which means liquidity will drain more quickly at this point. Banking system reserves currently stand at around $3.3 trillion, about where they've been over the last couple of years. That should start to ebb, but no one is sure how much they can fall before liquidity tightens too much. A dearth of liquidity would lead to volatility in the short-term rates, and it would compromise the Fed's control of its interest rate target. Interesting, something to think about. More macro. Consumer sentiment slides in August as Americans express heightened concerns about high prices. Consumer sentiment slipped in August as Americans primarily worried about the aspect of economy inflation. University of Michigan Consumer Sentiment Survey released Friday showed year-ahead inflation expectations among Americans climbed to 4.8% in August, up from 4.5% in July. The headline consumer sentiment came in at 58.2 for the month, down 5.7% from the last month and 14.3% from a year ago. This month's decrease was visible across groups by age, income, and stock wealth, said Joanne Su, director of the Survey of Consumers. Moreover, perceptions of many aspects of the economy slipped. Buying conditions for durable goods subsided to their lowest reading in a year, and current personal finances declined 7%, both due to heightened concerns about high prices. Expectations for business conditions and labor markets contracted in August as well. Against this deteriorating backdrop, only about a quarter of consumers expect to maintain their spending levels on items with large price increases, according to a report from University of Michigan released August 15. Consumers will get a fuller read on the labor market situation next week when the Bureau of Labor Statistics releases its latest job openings numbers on Wednesday and its monthly payrolls report on Friday. Private payroll processor ADP will release its own monthly jobs numbers on Thursday. Though the unemployment rate has been hovering between 4 and 4.2% since May 2024, job growth in the U.S. economy appears to have slowed markedly, with 73,000 non-farm payrolls added July, while May and June's job figures were revised sharply downward to a total gain of just 33,000 jobs. Friday's reading also came out shortly after the release of Fed's preferred inflation gauge, which showed price increases held mostly steady through last month, rising 2.6% over last year in July, matching annual increase seen in June. Core prices up 2.9% year over year, fastest rate since February. The report also noted that despite the divergence in economic views among members of the two mainstream parties, a growing share of consumers across the political spectrum expect interest rate cuts to be coming down the pike. I need to confirm this part right here. I had inflation which among Americans climbed to 4.8% in August, up from July's reading of 4.5. I thought it had gone down, but I'll check that later on my own time. Higher core inflation reading unlikely to knock Fed off course for rate cut in September. A fresh reading on the Fed's inflation gauge inched up again, but it isn't likely to knock the central bank off course to cut rates in September. I'm curious about this because I actually wasn't expecting a cut in September until Powell's speech. I thought it was 50-50, but Powell came up pretty strongly that he signaled a cut in September. And I think now most FOMC members are kind of lining up on that. But yeah, so let's see what this article says. Today's inline PCE price index will keep the focus on the jobs market. How is it in line? I don't understand. 2.9% core PCE, 0.3% month over month core. For now, the odds still favor a September cut, said Ellen Zettner, chief economic strategist for Morgan Stanley Wealth Management. But the size of the opening is going to depend on whether labor market weakness continues to look like a bigger risk than rising inflation. The PCE index on a core basis, which excludes volatile food and energy, rose 2.9%, up from 2.8% in the previous month. And I think next month is going to be 3%. So it's rising now, month after month after month. And the highest since February. On a monthly basis, core prices increased 0.3% for the second month in a row. On the headline basis, prices rose 2.6% in July compared with a year ago, matching the increase in June. Month over month, prices rose 0.2% from June to July, down from 0.3% the previous month. At the same time, the report showed that consumer spending picked up last month. While Fed officials are keenly watching how much tariffs push up inflation, the rise in core prices in July was due to a rise in service prices. That's further evidence that tariffs are having minimal impact on goods prices. Assistant economists at Capital. I think it's too early still. I mean, August is still a little early. I think it's going to be more September, October, November. But Chambers noted that breakdowns showed that core goods prices were unchanged on the month. Instead, the rise was driven solely by a 0.36% month over month rise in core services prices, which is expected given the strength of services CPI. While inflation is not moving in the direction the Fed wants to see, Fed Chair Jerome Powell said in a speech in Jackson Hole, Wyoming last week that a reasonable base case is that inflation from tariffs will likely result in a one-time increase in prices, and that the balance of risks appears to be shifting. Powell indicated there is concern about the direction of the strength of the job market given the lower payroll report for July and large downward revisions in May and June. He also noted that there's been a marked slowing in both the supply and demand of workers, suggesting that downside risks to employment are rising. If those risks materialize, they can do so quickly in the form of sharp higher layoffs and rising unemployment, said Powell. It may very well be that the next jobs report due out September 5 for the month of August could be a determinant factor for lowering rates at the September policy meeting. I think we covered the inflation report pretty well. So leave that alone. Let's look at the Chicago Business Barometer that came out today. Slowed down to 41.5%. This is the PDF from the Chicago Fed. So let's take a quick look at it. The Chicago Business Barometer produced with MNI slowed 5.6 points to 41.5. So this was way lower than expected. And I can get the expected figure right here. The expected figure was 46. Prior figure was 47.1. Now, this Chicago PMI has been lower than expected for a while now. But I think the size of the miss is, and it's an August data point as opposed to ones that the PCE personal income spending, etc. They were July, so a bit more timely. And I'm going to see some color from the Chicago PMI. Okay, so let's look at it. This almost fully unwinds the rise seen in July. The index has now been below 50 for 21 consecutive months. The decline was driven by a sharp pullback in new orders alongside falls in employment, production, and order backlogs. This was partly offset by a rise in supplier deliveries. New orders dropped 10.8 points. This was the largest fall since September 2023 and was driven by a decrease in the proportion of respondents reporting more new orders and an increase in the proportion of reporting fewer new orders. Employment compressed 5.9 points to the lowest since June 2020. The index has now more than unwound the 8.3 point increase seen in May. Production softened 3.6 points to the weakest level since December 2024. Order backlogs is 1.1 points. Supplier deliveries increased 5.8 points for the second month this year. No respondents reported faster supplier deliveries. Prices paid contracted 8.3 points for the second consecutive month. However, the index remains above the 2024 average. Inventories weakened 2.3 points. The survey ran from August 1 to August 11. Okay. And you can see here that the Chicago Business Barometer has been, for the last 2-3 years, been down, but it's kind of failing to increase, which is interesting. Special question: in light of tariff policy uncertainty, when do you expect to have a clarity on input costs? So majority, about 54%, expect next 3 months, so sometime in the second half of this year, by the end of this year, let's say, about 50% of the respondents. And then another quarter says it's going to take more than 6 months. So it could be past early next year. As labor costs remain high, have you considered sourcing or adding to automation, AI, digital technology, etc.? Okay. And then some publication. Not much more detail here except for the breakdown. I think the one thing to kind of keep in mind is employment compressed 5.9 points to the lowest since June 2020. So the depths of COVID pandemic is where Chicago Business Barometer employment is today, which is amazing. All right. On that note, thank you very much, everybody, and I will chat with you all next time. Take care.